Welcome to Introduction to Risk and Return, brought to you by canjo.com. Understanding the concepts of risk and return are fundamental to investing properly, and that's the focus of this video. So let's start by understanding what is risk. Risk is basically a measure of uncertainty. The more uncertain you are about an asset's true value, the riskier it is. Risk is measured using a statistical term called variance, which is used to measure fluctuations of value. So an asset that's fluctuating a lot, that's a riskier asset, that tends to have a higher variance. It's a high risk opportunity. A low variance investment opportunity, on the other hand, will not fluctuate as much in value. Its true value is more certain, and as a result, it is less risky. It is safer. So let's illustrate this by taking another trip to the world of Canjolia, where Joe is trying to decide between a couple of different investment opportunities. One thing he's looking at is U.S. Treasury bonds. Now, U.S. Treasury bonds are pretty low risk. Why are they low risk? It's because they are guaranteed by the U.S. government. And the U.S. government has the power to print as much money as it wants. So it can pay off the interest and the principal by just printing more money. It doesn't have to worry about tax revenues or anything like that. As a result, U.S. Treasury bonds are low risk, low variance. They do not fluctuate a lot in value, and they're generally a pretty safe investment. Joe is also considering stocks, which are a higher risk investment. Now, why are stocks higher risk? It's because there are a lot of factors in play. Stock prices can be determined by things like the company's earnings, which are determined by the management of the company, or stuff like the CEO's choice of products that he's going to develop in a given year, or the competitive landscape. There are all kinds of quantitative and qualitative variables, so stocks can either do really, really well or really, really badly. They have a high variance, and as a result, they are higher risk investments. Now, you're probably wondering, why would anyone invest in risky stuff? And that's a really good question. I mean, people don't like uncertainty. I don't like the idea of losing a lot of money on some risky investment, but there is a good reason, and that reason is the concept of return. Return is basically the expected growth rate of an investment. So when you hear about an expected growth rate of 8% or 10% or 12%, that is the expected return on your investment. And here is the important point. Risk and return tend to have a trade-off relationship. There is a trade-off between the two. Greater return investments tend to have more risk. So stocks tend to have a greater return than government bonds, and that's compensation for the additional risks. Stocks might have great fluctuations in value, but over the long run, they do tend to produce a higher rate of return, and this makes them attractive to investors. So that is the fundamental crux of the video, the relationship between risk and return. More risk, more return, and vice versa. Thank you very much for watching. I hope this video has helped you clarify some of these basic concepts. And if for similar videos, I recommend you check out my website, www.canjo.com.